Welcome everyone to our webinar today on Deal Structures 101, Understanding Equity, Safes and Convertible Notes. So welcome everyone, it's great to have you join us. My name is Georgina Toomey and I'm a practice group leader in LegalVision's corporate team. And I'm joined today by my colleague Dan Kim, who's an associate in our corporate team as well. Now, before we begin the substantive part of today's webinar, just a couple of quick housekeeping items. So you'll be emailed a copy of the webinar recording and the slides, a link to those for future reference. We will be undertaking a bit of a Q&A session at the end of the webinar, so do feel free to submit your questions throughout the session in the chat box and we'll come back to them in the last section of the webinar. And finally, we will be sending a survey link to you, so grateful if you could please complete that after the webinar. It's just a short survey so that we can keep making sure that these are relevant and enjoyed by all. So all attendees today as well are eligible to receive a free consultation with us to discuss how we can help you with your capital raising or any other commercial legal needs that you might have. So if you do want to take up that opportunity, then you'll just need to provide us with your contact details in the survey that appears at the end of this webinar. So do make the most of that. So in today's webinar, we'll be going through the following kind of headline topics, a lot to cover here, so relatively high level, but hopefully give you a really good feel for your different options in terms of deal structures. So we'll be looking at your best vehicle to raise funds. We'll be briefly touching on a dual company structure and what that means. We'll then dive into different options. So we'll start with loans, we'll talk to equity, convertible notes, and finally safes. Then we'll touch a little bit on the process around deal making and capital raising, and then finally go into that Q&A session. So again, make sure that you do put questions through as we go in that chat function, and Dan and I will answer them all at the end, or at least we'll try to get through them all. So now I'll hand over to Dan, thank you Dan, to discuss the ideal structure to use when looking to raise funds.
Thanks, George. So in terms of business structures, the best and most industry standard vehicle to raise funds with is a company. LegalVision does have a number of publications on this discussing a wide range of business structures, but in terms of 99% of the cases we see, we tend to recommend to set up a company structure for your business. You can only issue shares or securities which are convertible into shares, such as convertible notes and safes, which we will discuss later in this webinar, if you have a company structure put in place. So the company structure is the most straightforward and elegant method of splitting ownership. This is done by issuing new shares and therefore changing the percentage ownership in a company. If you have another business structure such as a trust or a sole trader or a joint venture, it can be a lot harder to do this because there's not a percentage or a pool of ownership there. For example, if you're a sole trader, exactly how you would split up the shares in your sole trader would be a bit complex, to say the least. So you can have a single company or a group structure of companies, so a multiple company structure. We'll talk to that point very soon. And even if you're raising money through debt, such as a loan, the company structure is attractive because your personal assets are protected through the company's feature of limited liability. Essentially, when you set up a company, you set up a separate legal entity which has its own accounting requirements, its own bank accounts. So the company will enter into that loan, take on the risk of that loan, and it will be met by the company's accounts to meet the obligations of that loan. So moving to the next point around a dual company structure. So with a dual company structure, you typically have a holding company, which is also known as a parent company, and then an operating company sitting underneath the holding company. So the operating company enters into contracts, such as contracts with suppliers, clients, employees, and your lease agreement as well. Basically, the operating company takes on the risks of the business. And above that is your holding company. The holding company is a passive entity which simply holds the group's valuable assets such as IP and cash. The idea behind this structure is that the operating company takes on the risks of the business and takes on those commercial risks under contract, whereas all the valuable assets such as the IP and cash is protected in that holding company, which does not trade. In most sort of structures, the operating companies are generally wholly owned subsidiaries. In other words, the holding company owns 100% of the shares in those operating companies which sit below it. Another term that's sort of flown around is parent companies and sort of parent-child relationships. So to explain that a little bit further, your holding company is the parent company where all the value is, and then the operating companies are generally the child companies that follow the direction of the parent. Sometimes they also operate separate arms of the business as well. So as a founder of a company and a group structure such as this, you'll be a shareholder holding shares in the top holding company. There's two ways in which those shares could be held. So those shares could be held in your personal capacity, or you could hold your shares through a family trust. So a family trust is beneficial for asset protection purposes and can be used to also as a generational income distribution tool. So you can distribute any dividends that you receive from the company into the trust, and then the trust can then distribute those to various family members as well. In terms of deciding, do I set up a trust or do I hold shares in my personal capacity? The key here is to determine the level of potential risk that arises out of your specific business operations and industry. If there's a potentially significant risk that you could be held personally liable, for example, for breach of directors' duties, then both the dual company structure and setting up a family trust to hold your shares as a founder may well be justified. And now I'll pass over to Georgina to discuss loans.
Thanks, Dan. And look, a lot of that that contextual sort of discussion very much comes down to business-specific considerations. So it's something that you would want to dive into with your lawyer to work out what is appropriate for your particular business and what isn't. There's also a tendency sometimes we find to overcomplicate structures unnecessarily. So you do want to make sure that it is justified. But look, plenty of advantages of that dual company structure for sure. So moving on then into the loan. So this is the first form of funding that we're going to talk to today. And the reason that we're starting here is because it's often the simplest and easiest instrument to understand, as well being the most familiar typically. So, recapping what you will all be aware of, a loan or a debt is when someone is lending you money and you promise to repay that money at some point in the future. So there's significant flexibility in the terms that can apply here, and there's a number of ways to structure the lending. And where you land, or where you'd prefer to land on these various options, will very much depend on whether you're the borrower or the lender, and also the particular bargaining powers of each party. So, for example, there you might have interest that is or isn't payable on the loan. You might be looking to agree to repay in installments, so maybe monthly or quarterly installments, or you may have negotiated to only repay at the end of the loan term, which is what we call the balloon payment. Often, if certain events will occur, so they're typically referred to as events of default, so this would be things like the company going insolvent, the lender can then often accelerate the loan. So in general, just basically making the loan immediately repayable. So it's really critical to make sure that you understand those terms before you sign. Now, a lender may also want to take security over some of your assets, in which case would refer to this as a secured loan. And this basically means that if you default under the terms of the loan, the lender has the right to take those assets and sell them, and using those proceeds to then repay the debt. Now, you don't have to give security. Again, it depends on lender risk appetite, it depends on the financial position of the company, it depends on your relationship. So it doesn't have to be in there, but again, it's a key term to consider before, again, locking in the loan terms. Now, moving to the advantages of using debt. So using debt as a form of funding is that you don't have to give up any ownership or equity in your company. So this is particularly attractive to founders. However, it is worth noting that early stage startups may find it difficult to secure debt funding on balance terms. And sometimes what we see is debt funding at that level is often limited to non-bank lenders on pretty heavily lender-friendly terms. We'll just move over to the next slide as well. Despite this, the debt funding, sorry, I was ahead of myself. So despite this, with the debt funding, it's typically flexible and straightforward to implement. The company does receive access to funds relatively quickly to expand its business operations, with the money then introduced being a simple kind of debt or overhead the company needs to pay back in time, rather than issuing shares and taking on additional shareholders. The main disadvantage is that, of course, the company does need to repay that amount, and typically with interest. So, from a company perspective, you need to work out whether you're going to have funds from a cash flow perspective, as and when they are due. Also, if you're paying interest, can you afford to pay that interest as it comes up on the loan? So now we'll turn to where your slides are at. That was my error, sorry, Dan. So equity, I'll pass it over to you, Dan.
Okay, so in terms of raising funds through equity, so just to recap, this will be a very high level sort of chat. There is a bit of maths involved as well, so please bear with us. So just kind of explaining the key concepts here and just trying to keep things as simple as we can. So every company has shares and there's 100% of shares. So shares represent a fractional piece of ownership in a company. So when a company undertakes equity investment, an investor will agree to give money to the company in return for a percentage holding of the shares in the company. And usually an investor will agree to give you money based on the post-money valuation of the company. So, for example, the investor will agree to invest a certain amount of money, and in return for their investment, they want 10% of the shares in the company after they invest into the company. So just working through an example here, and apologies again, bear with us, there's a bit of maths involved. So just for simplicity, to work through an example that's on the slides there. So there's 900 shares currently in the company, and the investor wants to receive 10% equity. So at a $1,000 post-money valuation. So the current value of the company is $900 before the investor invests the money. They will invest $100 in exchange for 10% equity. They will get 100 shares. So each share will be $1. They invest their $100. The value of the company will then be, after investment, will be $1,000. Sometimes we see that companies will have 100 or 1,000 shares. Again, the same principles apply, but there may need to be a little bit of a top up in the sense that if there's 1,000 shares, you'll instead need to give approximately 110 shares so that the investor has 10% of equity after they have put in their money into the company. So again, just keeping this as simple as we can, just the last kind of point on this sort of regard is that these numbers and these same principles can apply if the company was worth $1 million, for example, or if the company was worth $900,000, the investor invests $100,000 instead. So all these same principles apply. The investor puts in money into the company in exchange for a certain percentage of the company. So now moving on to employee share option plans. So what is an employee share option plan? So it's a mechanism early stage companies commonly use by which they issue employees and contractors options which can be converted into shares. This is another form of equity in the company. However, it's closely tied to attracting and incentivizing key employees to help successfully grow the company rather than being for the purposes of raising money. and why would a company want to put in an ESOP or an employee share option plan? The rationale for this is if the company can't sort of quite offer top market dollar to a key employee at that top market rate, they want to give a small sort of percentage or pool of ownership to the employee, and it incentivizes the employee to retain with the company. The idea being that they receive options at a point in time. The growth in the company's value will also increase the growth in the value of their options. So how is an ESOP typically set up? So you would ordinarily set aside a pool of options in your shareholders agreement. This can be typically about 10 to 20%, but based on current market trends, we're starting to see smaller option pools, more like 5% to 10%. In terms of the mechanics of an ESOP, so this pool of options is granted to certain employees, and they typically vest over a certain period of time, typically 3 to 4 years. Using a 4-year example, the options get allocated to the relevant employee. They would typically vest over 4 years with a 1-year cliff. So in the first year, none of the options will vest until the employee has stayed there for the full year. After that, they get their 25%, and the remaining 75% of the options continue to vest over that remaining 3-year period. So there are a number of ways in which founders can structure an ESOP for their company. The key consideration for structuring the ESOP will be whether the ESOP participants and employees will be able to exercise or convert their options into shares as soon as they're vested, or if the ESOP option holders can only exercise on an exit event and they are left as option holders, but they don't become shareholders. There's a little bit outside the scope of this webinar, but touching on it briefly just to sort of consider the different considerations involved. Sometimes founders do want key employees coming on board as very minor shareholders, for example, holding 1 or 2% of the company. Just the considerations to think there would be they will have voting rights and rights to dividends. If, however, the founders want to keep their employees at arm's length and want their cap table to be relatively simple, and the ESOP option holders cannot exercise or cannot convert their options into shares, they're kept a bit more at arm's length in the sense that they don't have those right to dividends. They won't be attending shareholders meetings, and they won't be listed on the company's office register as a formal shareholder. Before structuring an ESOP, though, we definitely recommend seeking taxation advice as to those two different options, because there will be a tax event that's triggered if the employee does exercise their options into shares. So it's very important to seek tax and legal advice as to how your ESOP should be structured so that the employees don't get a significant tax bill, and so that the company can also manage the tax properly as well. In terms of an ESOP and giving away ownership or sort of putting aside a pool of options in the company, is this attractable to investors as well? So the short answer is yes. So typically we do see that investors are keen to have an ESOP in place for the company. The reason being is that it's an effective retention tool for key employees or contractors. And the idea being that the key employees and contractors will be incentivized to stay in the business and eventually increase the value of the company overall. So it's more of a win-win for everyone involved. Implementing an ESOP before an investor invests into the company also allows an investor to understand their fully diluted holdings. So what that means is assuming if there was a 10% option pool, assuming if all of those 10% options were exercised, how many shares in the company would that investor have? And so this would be a question for the investor as to if they wanted 10% of the company, do they also want to consider if all the ESOP options were exercised, in which case they may want to seek slightly more percentage ownership in the company above that 10%. I'll pass back to Georgina to talk to convertible notes.
Thanks, Dan. I don't often get Georgina, but I appreciate it. Just touching on that as well, obviously, what Dan's covered there is there's a lot of levers to be pulled in terms of how you structure your ESOP. And we often find clients will come to us with the idea of implementing an ESOP, but they sort of don't really know how to tackle it. So often those first discussions are just talking through the different options, the advantages and disadvantages of each. And what LegalVision has done to kind of help address that is we've got a really great manual around ESOPs, which is a good overview of the different structuring options that you might want to think about. So look, if you are interested in seeing a copy of that to help you start thinking about how you might want to structure your ESOP, do let us know in that consultation that you can join at the end. We're more than happy to share that resource with you. So moving on to convertible notes. So this is a bit of a hybrid debt equity instrument. So we're starting to get a little bit more nuanced here. So a convertible note will either convert into equity or it's repayable on a trigger event, which would typically be a priced equity round or a liquidation event, or there's a maturity date that's set which triggers that. Now, the conversion rate is generally a discount to the share price of the trigger event itself, or it's a rate that's set by a predetermined or pre-agreed valuation cap. And it's usually a better off, so whichever results in more shares for an investor. Now, touching on the discount, this is typically set at 20%. That's relatively market standard. We don't often see it vary from there. And that's applied to basically reward the investor for their early commitment to the company. So explaining the application of that, say they've invested $100, the shares under the trigger event are issued at $1 per share. Your $100 investment will then convert into shares using a share price of 80 cents rather than $1. So you'll end up getting more shares than an investor investing under that particular priced equity round and what they would receive for their equivalent $100 investment. Now, interest is another element of convertible notes, so it's not always payable on a convertible note. However, if it is, what usually happens is it will accrue over the course of the life of the convertible note, and is typically only repayable on the trigger event. But that's a point of negotiation between the company and the investor. Obviously, to have it only repayable on the trigger event is attractive from a company perspective because you don't need to take that into account when you're cash flow forecasting. Now, turning to the advantages and disadvantages of convertible notes as against an equity round, the main advantage here is they're typically cheaper and faster to document. So less documentation required, more market standard documentation available, and not as much involved than an equity round. The other advantage here is a key advantage for early stage companies is it can defer valuing the business. So this is really critical for those early stage high growth startups, which are typically finding it really difficult to value the company accurately for the purposes of fundraising. So this advantage, however, can be significantly pared back if you are applying a valuation cap. Now, the valuation cap effectively sets an upper cap on the valuation at which a trigger event and therefore conversion will occur. It's the price that investors would expect to pay. So while you're not setting a valuation now, you're effectively setting an expectation for a future valuation. So it does pare back that key advantage of not having to set a valuation at an early stage. The other advantage as well of convertible notes is it offers great price protection for the investors. So the discount, the caps, even better than a full ratchet anti-dilution on a down round. That's another topic for a more kind of intensive webinar on equity rounds, but look, something to just flag there. So here the company basically takes on all the risk. Now, the disadvantages for convertible notes is that it can result in pretty significant dilution of existing shareholders if the discount or the valuation cap are not suitable where they're set. So again, we can provide advice to our clients on this as to whether the terms that have been negotiated are suitable, whether they're market standard. The key here is to talk to us before you sign your term sheet so that we can give you that guidance before you get locked into those terms. The conversion mechanics can also be quite difficult to understand, particularly if the company raises multiple convertible note rounds on different terms before it goes through an equity round. It does really complicate your cap table and it can make it quite difficult to understand the fully diluted position of the company when you are negotiating with external investors. So it's really important to have a really comprehensive, effective, correct cap table so that you can table that with your investors and not have the fact that you've raised multiple convertible notes as a negative in those discussions. And look, that's something that, again, your lawyer can assist with. We have got a great cap table tool, which often we will help a client translate their existing cap table onto that, and it helps you calculate the conversion mechanics when you are working with different convertible note rounds on different terms. And then the final point here is that there is a maturity date that applies to a convertible note. Now, what that means that basically, if you have not undergone a trigger event, so you haven't undergone a cap raise price equity round within, say, 5 years, then the maturity date mechanism occurs, and that allows the investor to require repayment at that point of repayment of their investment and repayment of any interest that may be payable. So not only is that administratively burdensome for the company, but it's also something to be really aware of, again, from a cash flow perspective, because that can be quite prohibitive if that does occur. So when you're negotiating your maturity date, you're looking at that 2 to 3 year runway, your capital raising plans, and working out the likely timing of your price equity round of your trigger event before you lock in that maturity date. Cool, so I'll pass over to Dan to touch on safes.
Thanks, George. So talking through the safe is the same as a convertible note in general, except that there's generally no maturity date, and this makes the safe more founder and company friendly. There's also no interest component as well, so it's definitely a lot more flexible to go down the safe route. So if you never raise funds, technically a safe will not convert. However, increasingly we are seeing people put maturity dates into safes because of the current economic climate, and investors are increasingly wanting to protect their investment as well. So while safes have typically not been used as much in New Zealand in comparison to convertible notes, they are starting to gain popularity. The reason for this is that they offer early stage companies a really straightforward and fast way to raise capital. And in a lot of situations as well, if the investors are fairly comfortable, if the company has already received offers from third parties and that there's going to be a price equity round very soon, the safe is a great way to get some cash into the company very quickly, knowing that the investor is going to have their shares under the safe convert in the price equity round that's going to take place in the very near future. And I'll pass back to George to talk about the process.
Thanks, Dan. Now, we're keen to round off the discussion so far about process, because process is obviously hugely important. It's often the key piece that we focus on when our clients first come to us saying that they're keen to raise capital. They sort of don't understand, or they want to get a bit more familiar, particularly if they haven't done it before, with what does that process look like. So it's absolutely relevant here. In terms of timing, this very much depends on which of the structure options you choose. But generally, our guide is it can take anywhere between, say, 2 and 6 months, which is obviously a very wide-ranging time period to work with. And that's once you've found your investors and you've got either DD largely underway or completed. Now that's longer often than investors expect. Now we have definitely seen raises that move a lot more quickly than that. We've also seen raises that have really dragged out much longer than that. A lot of it comes down to management of investors and those relationships and clarity over the key commercial terms as well. It's good to flag the expected timing because, again, it's really important for founders to make sure that they've got enough of a runway before they close so that they don't get into a situation where they have run out of cash and the raise has taken too long. Now, typically the first step is to get a term sheet agreed with your lead investor. This isn't always the case. So typically with a SAFE or a convertible note round, we'll often recommend to our clients, look, just go straight to the documentation. Reason being, the documentation is relatively simple, as we've touched on. It's pretty straightforward. There's basically market industry standard documents that get used, and so the benefit of a term sheet and then going into the formal documentation, there's no real benefit there other than additional time and cost, which we all obviously want to avoid. However, a term sheet for an equity raise is really valuable. Now, please do come and talk to us before you sign the term sheet. It will set out all the key commercial terms. Those are largely negotiated directly between the client and the business and the investor. But it's just really critical to have a chat with your lawyer before you actually put pen to paper on that, because while they are normally non-binding, it can often be quite hard to move away from those agreed commercial terms after you've signed, so you can lock yourself in quite quickly there. The next piece to touch on is due diligence. So this could happen either before or after term sheet stage, and it very much depends on what stage, I guess the comprehensiveness of that process will depend on what stage you're at, what raising round you're at. So if it's an early stage round, if you're raising, say, a friends and family round or angel investors, seed, normally what the investors will focus on is what's your company structure? Have you set up a dual company structure? What protections have you got in place for your IP, your key employees? What does your cap table look like? Now, this is a key part where we can really help you prep for your raise, so help you get your house in order, make sure that the IP is held in the right company, undertake a restructure if it's required by investors. The more prepared you are, the smoother and faster the raise process can be, as well as holding yourself out as a professional, organised, sophisticated company ready to really grow because you've got everything in place ahead of time. Investors find a huge amount of comfort in that approach. In terms of documents that you're going to need, now, again, this very much depends on which structure you choose. Typically, we'll include, if you're raising an equity round, you're likely to need to renegotiate or put in place, if you don't have one, your shareholders agreement and your constitution. You'll need your investment documentation in place, so that would be your subscription agreement for a priced equity round, or your convertible note agreement or your SAFE. And then there's some ancillary documents which, again, your legal team can prepare. Those are things like your corporate approvals that are required to raise the funds. It includes updating your share registers, updating the company's office register, things like that. Then you have the process where you sign the key investment documentation. You'll then have a period before completion. That can be as short or as long as you like. It's typically driven by your investors and how quickly they can get funds to fund. On completion, that's when the funds come in and you issue the security. Then what you need to do is you need to update the share register and you need to update the company's office register as well. Now, the key one there is your share register rather than the company's office register. Obviously, under law, you're required to update the company's office, but the share register is actually your legal evidence of ownership. It's often an easy miss for companies, so something to keep front of mind and make sure that you've done that as well. Now, we can obviously help end to end with that process. So, getting your house in order before you go to investors, taking you through negotiating the raised terms, and then getting you to close. So the idea is that you need sort of that wraparound service to kind of help you through that process and help make it as smooth as possible. So look, that concludes the main part of our webinar. We've got a really useful resource available to attendees today, which is our startup manual. That includes a really good high-level summary of what we've discussed today. It's a great go-to resource when you're looking to canvass your options with prospective investors. So that's in the handout section in the webinar panel, or you can either scan that QR code that you can see on the screen.
We also have an upcoming event that may be of interest as well. So our next webinar is what businesses should review before signing, and that takes place on Tuesday, 12th of December at 1 p.m. You can register on the link below. And onto the next slide. Yes, thanks. So we're going to answer your questions shortly. While you submit them, we'll take a minute just to tell you about our membership. So LegalVision membership is a cost-effective alternate way to have all your business's usual legal needs covered. In short, you pay a monthly fixed fee to have all your legal needs covered, covering you complete cost certainty as well as a full wraparound legal support service for your business. This membership covers off all areas of commercial law, including, for example, commercial contracts, franchising, corporate, leasing, and employment. Your membership also offers unlimited trademark registrations, which is often a critical but cost-prohibitive step for startups.
Well, thanks, Dan. And so now we'll move on to the Q&A section of the webinar. So I've got about 10 minutes for this section. So do make sure you submit any questions through. Look, if there's any that are, we've seen some that have come through, which are great questions, but very specific to a particular business. So sort of outside of the scope of this webinar. If you're one of the people that doesn't get their direct question answered, please do set up a consultation with us, because we'd love to talk to you about it in that consultation and really, I guess, tailor our advice for you. So do use that option at the end. So the first question, and I'll direct this one to you, Dan, that we've received is, can you recommend any ways of raising funds via potential investors, e.g. NZTE?
Okay, thanks, George. So yeah, in terms of this, you would want to decide the structure of the round using the sort of various mechanisms we talked about today. In terms of raising funds, is that going to be through a loan, or are you going to give away equity in the company as well? Or are you going to use a convertible or safe instrument? The other sort of thing we'd recommend is to have all, as George said, to have your house in order, to have all the company's key legal documents in order so that there can be a really clean due diligence process as well. And just sort of, yeah, having all those documents in place, getting that ready for raising any funds with, and then just sort of progressing the chats with NZTA. So that's what we'd recommend.
Fantastic. Another question that we've had is, how do I manage multiple investors? Now, this is a good one that we often come across and have to work through with our clients. So this is a very typical situation in the sense of you're wanting to raise, say, the $5 million round. You have one key investor that's going to fund 600,000. $1 million, whatever it is, and you want to fill out the round with the other investors that have shown interest. Now, what we typically recommend here with our clients is make sure that you try to negotiate only with one lead investor. Again, it looks to streamline the process, keep it straightforward. Typically, that investor then benefits from negotiating terms that are particularly favourable to them for taking that role. Then what happens is that you've, for example, negotiated your term sheet with that investor, then the company can go out to the other parties that have shown interest and say, look, these are the agreed terms. Are you keen to invest? These terms are non-negotiable. And obviously the lead investor is negotiating from an investor perspective. So the follow-on investors will typically take comfort that provided they are an investor that they are familiar with, or that they trust is sophisticated to negotiate effectively, then they'll be happy to follow on exactly the same terms. So what you'd do then is you'd fill out as much of your round in that way with your one lead and the balance of investors that are ready to invest. The other common situation that we have is we have clients that say, look, there's someone else who's really keen, but for various reasons at their end, they're going to be about, 2 weeks behind everyone else. They're not going to be able to fund in time. Now, look, that's fine. We basically apply what we call a roll and close. So we have one main close where we issue shares or other securities, and then we have an pre-agreed period of typically 60 to 90 days where other investors can jump on board up to an agreed maximum raise amount. Now, this is a really effective tool because particularly if you are successful in that first close, there's a real sense of FOMO or fear of missing out from other investors, and often that's enough to really push them across the line to jump on board and help fill out your round. Dan, we've got another one here for you. It's and we've touched a little bit on it already, but it's what is a cap table and do I need one?
Thanks, George. So a cap table, so first to answer that, yes, you should have one in place if you're looking to seek external investment, particularly in terms of the VC sort of process. A VC will typically have one, either require the company to have one in place or prepare one as part of the process. So in terms of what a cap table is, so it sets out all the securities on issue. So the company's office register will be limited to just the formal shareholders. For example, if there's 50% shares held by 2 people, whereas the cap table will set out all of the securities on issue. So this includes your ESOP, and then this includes your safes and convertible notes as well. So in terms of why you should have a cap table in place, so that helps calculate your share price based on the negotiated pre-money valuation. And it's good discipline to keep a cap table as well, and particularly up to date when working with convertible securities so that everyone can understand, oh, hey, look, if these convertible securities do convert, what is my percentage ownership going to be after these convertible securities do convert? So your investors will look to review and verify this during the due diligence process as well.
Great, thanks, Dan. And we've had a follow-up question just come in there as well, asking how does one structure the cap table of a party round? I'm not quite sure what the question is touching on there, but look, the cap table will be very much specific to your particular cap situation within your company. So the base position, as Dan's touched on, is just your shares actually on issue. Then it goes into the convertible securities. It will also touch on any options that you've issued to, say, under your ESOP. It will talk to your previous valuation. It will help you calculate the share price for new raises. Again, very much company specific, so I do encourage that attendee to reach out to us separately, and look, we're more than happy to have a look at your specific cap table, work out how we can finesse it if needed, or what else it might need, and how we can help on that front. We're more than happy to do that. We've got time for another couple of quick questions. We've had a question here around valuation. I'm keen to answer this one for the specific webinar because it's a really common question that we get from our clients when they come to us. Obviously, we've already touched on the benefits of a convertible note and a safe in terms of they kind of push the need to value your company further down the road until you're in a position where you can attach a fair market valuation to your company or attractive valuation to your company and justify that. So that's typically why earlier stages raises will go down that convertible route. If you are doing an equity round and you're not sure how to value your company, it's something that there's no specific mechanism to use here. It's usually company dependent. So we'd be looking at the size of the company, the stage, your industry. We're looking at competitors. In terms of a bit of a guiding principle, we do really encourage you to go out and talk to other founders in the industry. How do they value their companies? Have some open discussions with your investors. What's their feel for it? You know, and then also your accountant can also be really, really helpful there as well in terms of working out a valuation methodology that you can stand behind when you're having those negotiations with your investors. So look, no real specific answer there other than ask questions, do your research, talk to whoever you can. The startup industry in New Zealand is a very friendly and welcoming market, so you'll have lots of friends there to talk to help you navigate that. Now, that's all the time that we have for today. So look, after the webinar ends, a survey will pop up. We really do encourage you to complete that if you've got time. It's really useful information for us. It's also an opportunity for you to include your contact details to then receive that legal consultation to talk more specifically about how we can help you with your fundraising needs, especially if we weren't able to get to your question today. So look, thank you so much for joining us, and we hope to see you on our next webinar or one in the future soon. Thank you.